All right. Good morning, everyone. I'm Zhao from Lehigh University, and I will be the moderator for today's seminar. Today, we are happy to have Mengqiao from University of Mannheim, and she will present the paper titled Stock Repurchasing Bias of Mutual Funds. Participants can put your questions in the chat box, and I will bring up the question for you when appropriate. Mengqiao, you have 75 minutes, and you can start now.
Okay, thank you, Bei. Hello, everyone. Thank you for having us present our paper, Stock Repurchasing Bias of Mutual Funds. My name is Mengqiao Du. I'm from the University of Mannheim in Germany. I will be on the job market this fall. The co-authors of the paper are Alexandra Nissen-Hunti from University of Mannheim as well, and Terry Odin from UC Berkeley. In this paper, we study a new behavioral bias among mutual funds, namely the stock repurchasing bias. It refers to the tendency of mutual funds to repurchase previous winner stocks instead of previous loser stocks. It is related to emotional experiences and does not improve fund performance. It is important to learn the existence of the repurchasing bias and more generally, what kinds of behavioral biases exist among mutual funds. Because as we all know, mutual funds hold a large proportion of assets and invest on behalf of the retail investors. So our paper, our idea was motivated by the psychology literature. Emotional experiences influence people's decision-making. In our setting, when a stock was sold by a mutual fund, it was either sold for a gain or a loss. When a stock was sold for a gain, it represents a past success. Selling a stock for a gain is likely to be associated with positive emotions such as happiness and pride. Therefore, for the mutual funds, they are more likely to repurchase this kind of stocks in the future in order to remind themselves of this past success. By contrast, if the stock was sold for a loss, it is usually associated with negative emotions, such as disappointment, so it represents a past failure. Mutual funds would avoid repurchasing this kind of stocks because they would not like to remind themselves of a past failure. So if that is the case, if emotional experiences work this way, we would observe that in our whole sample overall, previous winners are more likely to be repurchased by mutual funds compared to previous loser stocks. And that is indeed what we found. So here is our motivation, and next, how does our paper contribute to the literature? Why it is important to look at emotional experiences. Okay, sure.
One quick question. In the previous slide, you talked about the positive and negative emotions. These are after you sell, right? These are realized gain and losses.
Exactly.
So does this intuition also apply to the paper gain and losses when you don't sell, right? But you do have a paper gain or loss. You feel the same emotion. I mean, is this gonna affect your purchase decisions?
Yes, you are right. We only look at paper gains and losses, the realized ones, because we think that for the capital gains and losses, it moves very fast, so it is very hard to measure. The managers, the mutual funds have the emotional experiences. Therefore, we only look at the cases when they eventually realized the gains and losses. And later on, I will give more details like how we measure their experiences. More specifically, we also only look at the complete cleaning the position of a stock. So that is what we think one mutual fund managers would attach an emotion to this kind of stock, at least to a much salient degree.
Okay.
So fund managers, they are professional investors, and they have more expertise and experience in investment and can learn about and correct trading biases more easily than retail investors. So we expect that a mutual fund manager's behavior is not that likely to be influenced by biases compared to retail investors. Consistent with this conjecture, according to the previous literature, we see that Barbara and Odin in 2007 found that attention influences retail investors' decisions about which stocks to buy. However, the decisions of fund managers are less influenced by attention. Similarly, the well-known disposition effect. Retail investors have been shown to be subject to the disposition effect. The findings are robust in different samples using different methods, but evidence of a disposition effect for mutual fund managers is mixed in Franzini 2006 and Cici 2011, when the authors use different methodology to measure the previous returns, they have different conclusions on the existence of disposition effect. However, fund managers have been shown to suffer from several behavioral biases. For example, the behavioral biases that are related to emotional familiarity, that is the home bias. Mutual fund managers are still biased towards the local stocks. And also behavioral biases that are related to personal characteristics. For example, the overconfidence. So along the line, whether fund managers are subject to behavioral bias may depend on the type of the bias. In another paper of Terry's Strahilowicz et al. 2011, the authors found that retail investors tend to repurchase previous winner stocks. And this bias is also related to emotions. Their previous emotional experiences on a certain stock influences the future likelihood of a retail investor to buy back a stock. Therefore, we conjecture that this bias also exists among mutual funds. Our paper finds exactly that is the case. Positive emotions from repurchasing stocks may add to retail investors' utility. So in their paper, they simply say that retail investors may have utility, may have emotional experience utility from like repurchasing previous winners. However, in delegated portfolio management, any utility fund managers obtain from repurchasing past winner stocks should not lead to increased trading in these stocks. Unless these stocks outperform others, or say the trading contributes to a higher fund performance. We do not find that is the case. So fund managers do not trade based on advantaged information. They simply demonstrate a repurchasing bias. So taken together with the previous literature, we found that even though fund managers are professional investors, they tend to suffer from emotion-based biases. So that is like how our paper contributes to the previous literature.
Shukanta Ray have a question. How does this
Yeah.
interact with the disposition effect? When conducting the original sale, you're more likely to sell winners. To sell a loser, it's harder. I guess you already mentioned the disposition effect.
So I guess
Yes.
the idea here is that I think you're treating the winners and losses as exogenous, but they're not, right? So it's easier for the fund managers to sell the original winners. It's much harder for them to sell the losers.
Yes, then it comes to how we measure the repurchasing bias. We always take into the opportunities for fund managers to repurchase winners and losers, or in other words, like how many winners and losers they sell into consideration already when we construct a measure for repurchasing bias. But that is a very valid point, and it will be interesting to think about like what stocks they sell in the first place before coming to repurchasing bias. But I believe we have taken this into consideration in our measures. Maybe you could let me know whether you think we have done it later on in the measure part. So next, this graph can show what we have found in our paper. So the x-axis are the intervals of the return on a previous sale, and the y-axis is the repurchasing probability. To generate this graph, we ran a regression of the repurchase dummy variable on each return intervals with a found stock and time fixed effects. We plot the estimated probability for each return interval, the experienced returns. The baseline interval is the interval around 0, that is -5 percentage points to +5 percentage points. The results show that the probability of repurchasing a stock is highly dependent on the return realized when the stock was sold. The probability of repurchase is approximately linear in return for losses and for gains less than 15 percentage points. So the coefficient on repurchasing a stock becomes positive when the returns moves from the negative domain to the positive domain. So we observe a kink around 0 in the slope of the repurchasing probability over return. But we can see that this is not symmetric, right? Stock's likelihood of being repurchased does not increase further for gains over 15 percentage points. So we think this may be explained by the loss aversion. So people seems to care about the magnitude of losses, but not the magnitude of gains. So that is also why we decide to focus on the comparison between previous winner stocks and previous loser stocks. So overall, on average, the previous winner stock, being a previous winner is very important for the repurchasing probability. As demonstrated in this graph, we indeed find that our baseline result, the repurchasing bias, mutual funds are more likely to repurchase stocks that were previously sold for a gain. And different from retail investors, mutual funds tradings and performance are influenced by fund flows. So we also check how fund flows influence the repurchasing bias. There are 2 time points. The first one is the flows at the time of the sale, and the second one is the flows at the time of the repurchase. We both found interesting results for the influence of fund flows on the repurchasing bias. And secondly, also what is different from the retail investors, for mutual funds, we can actually disentangle the mutual fund holdings and tradings with the fund manager's emotional experiences. So we further explore fund manager change in, again, 2 senses. The first one is when there is a fund manager change within a mutual fund. And secondly, that is for one fund manager sell a stock in one fund, and then they start to move to another fund and make repurchasing decisions. We also find interesting results here. At the end, we also examine the impact of repurchasing bias on fund performance. We examined the portfolio performance of repurchased winners and losers between the sale and the repurchase, or after the repurchase. We also relate the repurchasing bias to the fund level performance. I see there is something in the chart, so I read it.
Yes, Jerry had a question. Is there an emotional effect or bias that you agree? Would you expect it to be less prevalent in team manager funds? So I think it's a very interesting question. If you have multiple, say, portfolio managers, And if the selling, the previous one, right, is done by another portfolio manager, is this gonna affect the future trading decisions for the whole team?
So I think these are two questions. The first one is whether the management structure, team managed with single managed, differ in the repurchasing bias. We didn't have a good conjecture on that because for one team, for a fund, the managers may also have the same reference points and same emotional experiences. Therefore, it is hard to say whether team management helps increase or decrease the repurchasing bias. And actually, in our sample, the repurchasing bias exists among both team and single managed fund managers. I think I mentioned it later on in our findings. And regarding the second point, we haven't examined it. I'm not sure whether we have enough sample. It may be interesting to see, like, if there are a lot of cases like that. One of the managers in the team have experienced something, but others do not. How does this influence the repurchasing bias? Maybe we could have a look at that. That is an interesting point. Thank you.
So in addition to the behavioral side, could these technical trading rules generate something similar to what you find, like the positive or negative feedback trading?
So if that is, so the trading technique, if they actually exist, then it exists for some reason, right? But we don't see that this behavior gonna like improve the fund performance. So we believe that it is not something like momentum trading or any trading pattern that may, generate the same pattern.
So if they lose a lot on a previous trade and they follow this, let's say, negative feedback trading, they don't want to buy it in the future. It seems like if you go to your previous figure, that could generate something like what you show in the results. But I mean, maybe do some correlation between the technical trading rules and the score or whatever behavioral bias you have measured here.
Yes, maybe we will. Yes, that's. I think that's a valid point. We will check more about that. But later on, we will also show that in our regression, we control for example, fund times time fixed effects, and hopefully it may capture some of the patterns that are found usually, whether they use this kind of technical trace or not. But you are right. I will think more about it, and we will think whether how to incorporate it in the paper.
Thank you.
So here are the main results and the motivations. If there is no further comments on this part, I will move on to the empirical details. So first is about the data. For the main data set we use is the quarterly holding data from Thomson Reuters Mutual Funds Holdings database. The sample period is from 1980 to 2019. The database is quite standard, and then we merge the quarterly holding data with CUSP Mutual Fund database and Morningstar. And for stock characteristics, stock price from CUSP, and financial statement information from CompuStart. In this sample, we have more than 11 million fund stock quarter observations, 5,725 distinct funds. And in our sample, we only have actively managed equity funds in the US. To more precisely calculate previous trading returns, it would be better to have holding data with higher frequency. Therefore, we also have an alternative sample the institutional transaction daily the data. It is on the daily level from the Abel-Noza solutions, usually referred to as the Anserno data. The sample period is from 1999 to 2010. It allows us to more accurately calculate the realized returns of mutual funds on a certain stock. To make a sample, to make the repurchasing activities comparable to our main sample, we accumulate the daily institutional trading data to a quarterly level. And in the end, our Anserno sample consists of more than 3 million fund stock quarter observations, include 971,000 complete sales by 4,602 funds. So we have two samples to check the robustness of the results. And since it is not possible to identify the funds or fund managers in Anserno data, we mainly focus on the quarterly holding data for more detailed analysis. I see another question from the chart.
From Vikas, is this bias driven by managers' own preferences or from investors' preferences? I guess you mentioned the flow result. Maybe you can talk more.
Yes, maybe we can talk more about it when we see the results on flows. But for the flow results, we haven't tried to relate that to, I know what you mean is like a kind of an adapting to the tastes of clients. We didn't think about the bias that way actually, but we will later on. We will think more about that and maybe try to use that to explain the results in our flow part.
Yeah,
just to add to it, Mengqiao. So I did a paper recently on fund managers holding lottery stocks. And, what we did was like, it could be possible that the fund's investors are having a preference for those kind of stocks. So what we did is we looked at the manager's ownership in the fund. If the manager has a lot of ownership in the fund, and they are basically having this bias, then it's basically their own money that they are, that's subject to this bias. So that's one way we actually try to test this. The other thing we did is you can sort of classify funds into retail and institutional to see if there is any difference. Of course, it's not perfect the way that you classify, but at least you can see if there are any differences.
Yes, thank you very much, because that is very helpful. We will think more about whether the bias is to adapt to the taste of clients. So this is our data sets we use. And in the next step, in this small example, I want to present how we construct our sample. And it is also related to the previous question on, how we construct our sample regarding the opportunities to repurchase previous winners and losers. In this example, I use only one stock, the Microsoft. It appears in our sample for 7,730 times. These are all complete sales. And 1,067 times after the sale, Microsoft was actually repurchased by the mutual funds. And I further restrict the sample to just one fund, a Fidelity fund. It has sold Microsoft 4 times and repurchased it 3 times in the sample period. After each time the Fidelity fund sold Microsoft, we track the portfolio holding of this Fidelity fund for 4 quarters, that is 1 year after the sale. If the stock Microsoft reappeared in the stock holding of the fund, then the repurchase dummy is 1. Otherwise, it is 0. For example, in Q2 to 1992, the Fidelity Fund sold Microsoft as a gain. It's like 56%, and then in the quarter afterwards, in Q3 1992, we do not observe Microsoft in the stock holding of Fidelity Fund, so the repurchase dummy is 0. And in Q4 1992, Microsoft reappeared in the stock holding of the Fidelity Fund, so the repurchase dummy is 1. And then there are cases when Microsoft was sold but never repurchased by the Fidelity Fund in the year after the sale. And that is, for example, after the sale of Q2 2011, from Q3 2011 to Q2 of 2012, Microsoft did not reappear in the stock holding of the Fidelity Fund. So we generate 4 observations in the sample with a full dummy variable repurchase as 0. So in this way, we construct a sample of actual repurchasing activities. That is the cases when the repurchase dummy is 1, and the opportunities to repurchase the previous winner or loser stocks. That is the cases when the repurchase dummy is 0. So here is how we construct our sample, and I hope the small example could help demonstrate how we did that. And in the Ensemble sample, it is exactly the same how we did it. We again accumulate the data to quarterly level and measure the repurchasing activity. But the only difference is that the return is more accurate because we have the daily transaction data. So if there is no question on how we construct the sample, we will move on to how we construct our main independent variable of interest. We do not know how the mutual funds measure their gains and losses, in the sense that we may know or say estimate, if we use the quarterly data, the price of sales. But what is the price of purchases? How do they calculate the average purchase price? We use different measures to measure the previous gains and losses. We present the results using 2 different measures, and we also use further measures and as a robustness check. The first one is called winner first in first out. It is a dummy variable equals to 1 if the price at the time of the sale is larger than the weighted average purchase price based on the first in first out principle. This first in first out principle is usually used by many papers using quarterly holding data. And but we think that probably nowadays it is not that hard to calculate an average price without even first in first out principle, especially for institutional investors. So we also have another measure called winner average purchase price. It compares the price at the time of sale with the trade value weighted average of all purchase prices before the sale. So this measure ignores the sequence of purchases. So as long as a purchase was conducted before the sale, we put it as our input and use the trade value weighted average of all purchase prices. So these 2 are our main measures of winner dummy, the previous winner stock, to determine whether a stock was a previous winner or a previous loser. So next, let's move on to our summary statistics. We found that stocks in the main sample are repurchased by the same fund within 1 year with a probability of 5.3% on average. and the repurchasing probability is slightly lower in the ancestral sample, that is 4.7%. And according to the winner first in first out measure, indeed slightly more previous winners were are in our sample. So 50.7% of the stocks in our main sample were actually sold for a gain. And the measure is likely higher when we use the average purchase price. In the ancestral sample, 49.1% of the sales are at a gain based on the measure first in, first out. So that is the summary statistics in our sample, and the average repurchasing probability is usually used as the benchmark when we measure the economic magnitude of the repurchasing bias. So we compare the difference in the likelihood of repurchasing previous winner and loser with the baseline repurchasing probability. And in the next step, also as a part of our summary statistics, we show in the first table up here, we show the mean comparison of stocks repurchased and stocks not repurchased. We see that in both data sets, a winner first in first out and winner average purchase price are greater for stocks repurchased than those not repurchased. Therefore, funds are more likely to repurchase a stock if it was previously sold for a gain. I also see a question in the chart.
The question from Jensen, do you differentiate winner or loser based on systematic return versus idiosyncratic return? When it's systematic, like exogenous, maybe you blame yourself less. I think the idea is.
Yes, that is a very interesting question. So, but we think it from another perspective. We first here we just use the overall return as the measure for previous trading experience, but we also check this. We also compare this return with the market return to see the excess returns mutual fund managers experience, and it still has the same effect regarding the repurchasing bias. So I would say both parts contribute to the repurchasing bias.
Another question from Jerry: to what extent could these emotional managers be simply following revisions in sell-side analysts' recommendations, say following upgrade downgrades in response to firm beating missing earning estimates?
I will need to think about that. So for when an analyst upgrade in response to, if the firm performs well and have a higher earning and analysts update that, the fund managers may react to this. But I mean, how this relates to the previous trading experience, hopefully we will have enough heterogeneity in terms of different funds experience the different returns on these stocks, right?
Yeah, I guess it depends on how they revise the recommendations. If it's more like some stickiness in the recommendations, maybe.
Exactly. They may correlate it somehow, but hopefully using some high dimensional fixed effects, we take out some of the influences. We control for stock times time fixed effects. But maybe we could discuss more after seeing the results. But I have to think more about how they correlate. For me, from my point of view now, I think indeed they may the analyst recommendations may correlate with the previous trading experiences, but I hope that we have enough heterogeneity to take out that influence. But thank you, that's an interesting point. So now we have seen the mean comparison of stocks repurchased and stocks not repurchased. Next, in the next table, we show the mean comparison of stocks previously sold for a gain and stocks previously sold for a loss. We observe that the probability of being repurchased is between 1.1% in the main sample and 0.7% in the ancestral sample, higher if the stock is a previous winner rather than a previous loser. This corresponds to 21 or 15% relative to the baseline repurchasing probability in each sample. So at least when we only see the mean comparison, we observe an economically large repurchasing bias here. So far we have talked about the data, the sample construction, and summary statistics. So in the next step, we will move on to the baseline results. First, we show the previous experienced returns using a simple figure here. The figure shows the average return from a stock's complete sale, conditional on later on whether this stock is subsequently repurchased for our main sample in the quarterly sample. The stocks repurchased tend to have been sold for higher returns than stocks not repurchased. Using the winner first in first out dummy, the difference amounts to around 3.6%. When using the average purchasing price measure, the return is more than 4%. The return difference is more than 4%. So we, at least like at the first sight, we see that conditional on whether subsequently the stock was repurchased or not, their experienced returns differ. And in the next slides, we show the ratio comparison. So this is a very popular method used when we usually study the disposition effect. So we have two measures. The first one is proportion of winners repurchased, and the second one is the proportion of losers repurchased. And then we compare the difference of these two ratios against zero using t-tests based on the assumption that realized repurchases are independent observations. The proportions are calculated as the ratio of the number of winners repurchased or losers repurchased divided by the opportunity to repurchase winners or losers. Indeed, we see that the difference is 1.1% or 1.2%. And the difference is statistically significantly different from zero. And yeah, so I see a question in the chart.
Yeah, from Vikas, is this bias in funds driven by a similar bias in individual investors trading? In other words, are funds simply trying to benefit from this bias in individual investors, and it appears that they have the same bias?
So we think that first, mutual funds do not benefit from trading this way because we find like a weak negative association of the repurchasing bias with the fund performance. Yeah, individual similar. When individual investors tend to do things in a similar pattern, can mutual fund investors take advantage of that? I think still the bias is on the fund level based on the previous trading experience of each fund. Especially if we also involve retail investor trading, it would be so different among different investors, and hopefully overall we would not see that mutual funds can take advantage of that. But yeah, we will think more about that. But I think hopefully, I don't think it's possible if different retail investors may have different experiences on a stock, right?
Okay.
Mm-hmm.
So I guess another difference between individual and the fund manager is for individuals, they typically hold or trade only a few stocks. So the winning or losing experience might be more clear, right? Stay longer in the memory. But for fund managers, they trade, hundreds, or dozens of stocks on a daily basis. So do they keep a record? I mean, do they look at the past winning or losing records when they place a trade? I mean, there are hundreds of stocks, right? So so many positions.
Yes, I agree that they may trade on many stocks during a short period, but if we only consider the cleaning position, the complete sales, they may not be that much, right? So like many cases, mutual funds may trade for liquidity reasons when they encounter outflows or inflows, but like when they finally decide to completely sell a stock, I think they may remember that as a success or a failure based on the subsequent the subsequent gains or losses they have in this trading.
Okay.
So, and indeed we found some effects. So
thanks.
But I think it is interesting to think about the differences between retail investors and mutual funds. Thanks for the point. So now we just have a simple graph and a ratio t-test. We want to formally test the repurchasing behavior. So we have a linear probability model with various fixed effects. We estimate the dependent variable is the repurchase dummy. It is an indicator for whether the stock sold completely by a fund is repurchased in the quarter within 1 year after the sale. And the winner dummy denotes our two measures of winner stocks: winner first in, first out, and winner average purchase price. We include various fund characteristics as control variables, fund size and age, which may represent like what Haibei just mentioned. Large funds may have more stocks in the portfolios. And we also control for the fund's turnover ratio, since turnover may positively related to repurchasing behavior and also performance. We also control for expense ratio and performance rank and return volatility. So our model include stock, fund, and time fixed effects to control for unobserved fund trading patterns, stock characteristics, and potential time trends in repurchasing behavior. Fund fixed effects take out time invariant fund characteristics. For example, the investment style, or even at least a part of the management structure, whether how they are organized. And fund times time fixed effect allow fund characteristics to vary over time. We assume that the repurchasing behavior is independent across funds, but not within funds. So we cluster the standard errors by fund. This table shows our main results. In column 1 and 4, we estimate the baseline effect without any additional control variables. In column 2 and 5, we control for fund characteristics. We include font times time fixed effects in column 3 and 6. And across all specifications, we find that mutual fund managers are significantly more likely to repurchase stocks that they previously sold for a gain. The impact of the winner dummy on the probability of a stock to be repurchased is positive and statistically significant at the 1% level in all model specifications. And the effect is also economically large. Depending on the winner measure and the model specification, the estimations show that the probability of being repurchased is like 0.8 to 0.9 higher for previous winner than for previous loser. And if you still remember, the average repurchasing rate is 5.3%. So the difference corresponds to around 17% higher probability for a winner to be repurchased. Okay,
we
so
have two questions. One from Anish. Since the phenomenon is related to behavior, should it have fund manager's experience instead of fund age as control? I think it's a good question. There are some studies showing trading experience mitigates behavior bias.
Yes, so for now, since the holding data is at the fund level, so for now, we conduct our analysis at the fund level. So it would be a bit complicated to control for fund manager characteristics. It is also possible, but anyway, we also do analysis on the manager level later on. And we control for font times time fixed effect. It would be interesting to see how fund manager trading experiences influence the bias, but at least this cannot totally take out the bias since we have font times time fixed effect.
Yeah,
Thank you.
Unless you
for
have
the
a changing
points.
manager, but you also look at that. So Yuhua had a question.
Yeah, sure.
Yes, I want to ask directly. I thought those high-dimensional fixed effect are interesting. I've been using those in my own work, including the paper with Sugata. So here's one observation. It could also include stock times time fixed effect. Is there a reason why you do not?
We did that, but we presented in a separate table for some reasons. We will talk about it in the next slides, which I think if there is no further question about the current one, we can do it now. So
the follow-up question is, no, I mean, the reason why I ask is there's no reason I see why you do not include it, because it could be a stock driven. You can easily explore a cross fund within stock variation. And the second one is, I'm curious if you cluster your standard errors a bit more conservatively. So in our experience, we got comments to cluster the standard errors three-way by fund. It's like a three-way cluster by fund, by stock, and by time. So we find that matters to the T-stat quite a bit.
Yeah.
You got a T-stat which is, your standard error is very small. I don't think it will be kill your result, but I'm curious to see whether what will be the standard error or the T-stat after you class this. I mean, because you have reason to believe that cluster by fund, but there could be cross-sectional correlations, the residual within the stock or within time, and just two thoughts. Yeah.
Yeah, I totally agree. Like we check the robustness by clustering the standard error by fund, time, and stock. That is a very valid point. And as you can see, the standard errors are super small. We have a very large sample, so indeed it does not influence our results. And for your comments on stock times time fixed effects, it's super interesting to see the results as well. We indeed have done the analysis, including stock times time fixed effects. The thing is, now we are comparing the repurchasing rates of the same stocks in the same quarter, conditional on whether a stock sold a fund sold the stock for a gain or a loss. But for the same stock in the same quarter, it is not always possible to have funds selling the stock for gains and also funds that sell the stock for losses. In other words, we are by controlling stock times time fixed effects, we may take out a part of the repurchasing bias we want to capture. We want to compare the cases when funds sell a stock for gains with those sell a stock for losses, but now we have to focus on a stock within a quarter. But anyway, we still found the positive effect of the winner dummy, and the coefficient estimates are still positive and statistically significant at the 1% level. But as you may notice, the economic magnitude is lower. It corresponds to around 5% of the repurchasing rate. We believe that it could be that the magnitude of gains and losses are small in these cases. Because when a stock is sold by one fund for a gain and by another fund for a loss within a given time period, there won't be enough variations in the magnitude of gains and losses. So we may not observe a very big difference in the repurchasing rate of previous winner and loser stocks. And secondly, the estimation errors could also lead to miscategorizing small gains as losses and vice versa, small losses as gains. So we have a smaller economic magnitude. You could also say that maybe the stock characteristics can partially explain this pattern, but still we find significant repurchasing bias, even controlling for stock times fixed effects. So even for the same stock in the same time period, the probability to be repurchased is dependent on whether the stock was previously sold by a mutual fund for a gain or for a loss. So that is very interesting point to control for stock times time fixed effect. And we indeed do that. We still found significant repurchasing bias, but the economic magnitude is smaller. Unfortunately, we may not have enough variations in gains and losses. And so that is our main result. So I think we are reaching we only have 20 minutes. So maybe I will quickly jump to the next part of analysis. So for the anciennial data, it is not possible to control for measurable fund characteristics since we cannot identify these funds, but we still have fund times time fixed effect or stock times time fixed effects. We still find the repurchasing bias, so our results are not driven by potential inaccurate estimation of previous returns. We also check use different ways to calculate the winner measure, like low in first out, high in first out, last in first out, or even like the last holding period return. And related to the previous question on systematic or not, the return is systematic or not, we also use market-based winner measures, use the relative performance to S&P 500. We also consider, this is also mentioned previously, we also consider the management structure, and we find repurchasing bias among both a team and single managed funds. Another thing is that some investors may be concerned about the capital gain taxes implications of a mutual fund's trades. So stock repurchased within 30 days of being sold for a loss cannot be claimed as a capital loss for tax purposes. So to exclude the tax wash rule explanation, we exclude the first quarter after the sale and still found the repurchasing bias. So now we have established the robust baseline result on repurchasing bias. Next, we examine the influence of flows. So how flows will influence the repurchasing bias. Fund flows are found to influence trading and performance of mutual funds. For example, in Alexander 2006 paper, the authors suggested that mutual funds trades associated with outflows are more likely to be liquidity motivated, and mutual fund trades associated with contemporaneous inflows are more likely to be traded for liquidity reasons, for valuation reasons. So how fund flows can influence fund repurchasing bias? There are again 2 time periods. The first one is the flows at the time of sale. If the mutual funds encounter fair sale, in other words, they sell the stocks when encountering outflows, then the mutual funds this kind of tradings may be associated with less emotion, and the repurchasing bias is expected to be less salient. And at the time of repurchase, when fund managers encounter inflows, they have to buy some stocks during a given time period. Then they may demonstrate. They may be more likely to demonstrate behavioral biases. They didn't think. They do not think thoroughly on which stocks to buy. So they may be more likely to repurchase previous winner stocks. And if that is the case, the repurchasing bias may be more salient if funds experience inflows when making repurchasing decisions. So this is what we found. In panel A, at the time of sale, we found that if the stocks are sold when stocks encounter outflows, the repurchasing bias is less salient. That is, the repurchasing bias decreases around 1/3. Mutual fund managers may have sold the stock due to liquidity reasons, so they do not have impressive emotional experiences compared to sales due to valuation reasons. And in panel B, at the time of repurchase, I'll say potential repurchase, at the time when they make repurchasing decisions, we found that if the stocks are under consideration of being repurchased when funds encounter inflows, the repurchasing bias increases by half, from 7% to 10%. So mutual funds may suffer more from the 0.7% to 1%, sorry. Mutual funds may suffer more from the repurchasing bias when they have to quickly allocate the capital flows. So at the time of sale and repurchase, we found some interesting findings on how flows influence repurchasing bias. And we will take Vika's comments into consideration on whether they accommodate to retail investors' tastes. So that is our results on fund flows. Next, we explore fund manager change. If a fund's repurchasing bias is due to the fund manager's positive or negative trading experiences from selling stocks for a gain or loss, we would expect decreased our bias after a manager change. Furthermore, in another case, if fund managers who change funds they manage carry the emotional associations from previous experiences with them, they may demonstrate a propensity at a new fund for repurchasing stocks they sold for a gain at an old fund. In this part of analysis, we restrict the sample to single managed funds to clearly determine a fund management change. Since we have shown that no matter whether it is a team or single managed fund, the repurchasing bias is comparable among both groups. So we believe restricting the sample to single managed funds will not bias our analysis, but it helps a lot in determining the fund management changes. The first table examines whether fund manager changes help decrease the repurchasing bias in a given fund. We define a dummy variable manager change, which is equal to 1 if a stock was sold when an old fund manager A is taking charge, but the repurchasing decision is made after another fund manager, let's say fund manager B, has taken over. We then run our baseline linear probability model, additionally including an interaction term of the winner dummy with the manager change dummy. In all specifications, the coefficient estimates of the interaction terms are negative and statistically significant at the 5% level. Like the results in column A would mean that the new fund managers are 0.3 percentage points less likely to repurchase previous winners sold by their previous fund managers than fund managers who remain in charge of the same funds. The decrease is actually about half of the baseline repurchasing bias. So indeed, after the fund manager change, mutual funds demonstrate less salient repurchasing bias. And also consistent with our intuition, the effect of a manager change also has a negative effect on the repurchasing probability. So after a manager change within the fund is less likely to repurchase a stock that was previously sold by another fund manager. Overall, we see a decreased level of repurchasing bias and also a decreasing level of repurchasing probability after a fund manager change within the fund. So this is kind of consistent with our conjecture that the repurchasing bias comes from emotional experiences. In the next analysis, it again confirms that the repurchasing bias is more likely to be associated with personal experiences. We analyze whether fund managers carry their trading experiences with them when they change the fund they manage. The sample now consists of repurchasing activity and opportunities to repurchase stocks previously sold for a fund manager in another fund she managed before. Therefore, the repurchase dummy is now defined at the fund manager level. So the repurchase dummy is at the manager level, and the sale happened at an old fund, and the repurchasing decision happened in a new fund. To account for the fact that fund managers may be responsible for several funds at the same point of time and sell the same stock through different funds with different returns, we use the value-weighted average returns in panel A. And in panel B, we further restrict our sample to single managed fund and one manager only manages one fund. It is more clear what is the emotional experience of the fund manager on a certain stock. Anyway, no matter how we do the measurement, we find that the fund managers still demonstrate repurchasing bias in the new fund they manage. You may have seen that the economic magnitude seems to be small here, but actually the average repurchase rate decreases after a fund manager changes the fund they manage to 0.9 percentage points. Therefore, the economic level of the repurchasing bias here is still like 1/3 of the baseline repurchasing rate. After changing a fund manager manages, the manager is less likely to repurchase an old stock, but still they are more likely to repurchase previous winners compared to previous losers. So far we have seen the baseline result on repurchasing bias, how fund flows and manager change influences the repurchasing bias. We believe that the repurchasing bias is driven by emotional experiences. In the end, we examine the impact of repurchasing bias on fund performance. And this part of our analysis also helps us exclude many potential explanations. For example, they may buy the previous winner again because fund managers have information advantage on these stocks, or they may have some trading patterns they would like to apply. But if they do not have, if these trading patterns or information advantage does not help improve the fund performance, we believe that it is simply an emotional experiences. First, let me see, I have 7 minutes. So we first do analysis on the portfolio level. We construct fund portfolios based on the repurchased winner or loser stocks, the stocks that are repurchased within 1 year after the sale with a gain or loss. We form portfolios with repurchased winner stocks and repurchased loser stocks in each mutual fund portfolio in the month between the previous sale and the repurchase of the stock. So first we look at the portfolio performance between the sale and the subsequent repurchase. Monthly returns of the winners and loser stocks in the portfolios are weighted by the fund's dollar holdings. We then compute the calendar time portfolio of repurchased winners and losers by taking equal weighted average across funds. And then it is important to define the benchmark. We use the fund portfolio performance as the benchmark. It is calculated as the value, the equal weighted average of returns or risk-adjusted returns across funds. So here is the table contains the calendar time portfolio of returns and alphas between the sale and repurchase of previous winner stocks, previous loser stocks, and the benchmark portfolio, the funds that sell and repurchase these stocks during the same time period. We compare the difference between the winner portfolio, fund portfolio, loser portfolio, fund portfolio, and then winner portfolio against the loser portfolio. It seems that the winner, the repurchased winners outperform the fund between the sale and the repurchase. Repurchased losers slightly underperform the fund if we use CAPM or Pharma-French alphas. And definitely previous winner stocks underperform previous loser stocks between the sale and repurchase. It seems that indeed mutual funds forego a part of the gains the repurchased winner stocks would have given them if they simply kept the stocks in their portfolio, if they didn't sell and repurchase these winner stocks. But of course, you could say that this is ex post estimation. We look at the performance between the sale and repurchase, but still conditional on being repurchased, it would be better for the mutual funds to simply avoid trading on these stocks. Then we also construct similar portfolios, but look at different time periods, that is a quarter after the repurchase. The way that we construct the portfolio is the same as what we did before, but now we look at the months in the quarter after the repurchase. Again, what would be the appropriate benchmark? So in addition to the fund portfolios, we also have a portfolio consisting of newly purchased stocks, because we are afraid that the purchased stocks are different from the stocks that are in the fund holdings. So we want to establish a more valid comparison. We have a portfolio of previous winners stocks that are sold and repurchased, previous loser stocks, and a new purchase portfolio, which consists of stocks that are not repurchased, but just newly purchased by the funds. And we also have the funds that make all these transactions. Here we do not find much significant result. We see some evidence that if indeed mutual funds decide to repurchase previous loser stocks, these loser stocks slightly outperform the mutual fund here. If we use the raw fund return measure or the Carhart 4-factor alpha, the loser also slightly outperformed the newly purchased stocks, and at least the previous winner stocks underperform previous loser stocks after the repurchase. We have to admit that the results are only marginally significant in some measures, but at least the funds are for sure not repurchase these winner stocks because they have information advantage. And in the end, we do the analysis at the fund level. We investigate the effect of repurchasing bias on mutual fund performance. We compute a fund's monthly net return or its alphas as measures of fund performance. We sort these funds into quintiles according to the extent to which they are subject to repurchasing bias. The repurchasing bias is determined by the ratio of PWR divided by PLR. If you still remember, these are the two ratios, the proportion of winners or losers repurchased we calculated at the beginning. We use the ratios of these two ratios to measure the level of repurchasing bias. Funds with the highest PWR divided by PLR ratio are included in the top quintile, and the portfolios are formed for each quintile and are held for 3 months on a quarterly basis. We then compute the equal-weighted performance of the portfolio for each quintile. The difference of the returns and alphas between the top quintile and bottom quintile is negative and statistically significant at least 10% level, but only when we use CAPM or Carhart 4-factor alphas. So when the performance is measured by cohort alpha, the highest quintile earn around 1% less returns than the bottom quintile. We do not observe a monotonic pattern in the relationship between fund performance and repurchasing bias. The repurchasing behavior does not constitute a very large proportion of the fund trading, unfortunately, but at least we confirm that funds that demonstrate the most salient repurchasing bias underperform. So that is basically all our results. We demonstrate a very robust repurchasing bias. It is the first evidence that mutual funds are biased towards repurchasing stocks that they previously sold for a gain rather than for a loss. Our results are consistent with positive emotions driving the repurchasing behavior because we demonstrate how a manager change influences the repurchasing bias, and also the repurchasing bias does not contribute to a better fund performance. Our results are important for investors delegating portfolio management to actively manage the funds, since we highlight that mutual funds are subject to behavioral biases too, and more specifically, they suffer from emotion-based biases. Thank you very much for your attention and comments. So that's
all right. Thank you, Mengqiao, for the presentation, and thank all the participants for the great questions. Our next seminar is going to be on April the 28th, which is going to be our grand finale for the seminar series. So we really look forward to seeing you in 2 weeks. Thank you.
Thank you.
Stop the recording.